Have you ever wondered how an entire economic system can nearly collapse just because of houses? That's exactly what happened during the 2008 housing crisis. And the truth is, it changed the world. So let's unpack it, step by step. In the early 2000s, everyone wanted to buy a house. Homeownership was the dream. Banks saw an opportunity. They started giving out mortgages to almost anyone who asked. Here's the question. What happens when banks stop asking, "Can you really afford this?" They hand out risky loans. And that's exactly what happened. These risky loans were called subprime mortgages. They went to people with shaky credit, unstable income, or very little savings. In normal times, banks would have said no, but during the housing boom, the answer was yes. Why? Because lenders thought housing prices would keep going up forever. If someone couldn't pay, the bank could just take the house and sell it for more. But that logic had a flaw. Let's pause here. Have you ever seen a bubble form in a soda glass? It grows bigger and bigger until, pop, it bursts. That's exactly what was happening in housing. Here's the twist. Banks weren't just sitting on these risky loans. They were bundling them together into complicated packages called mortgage-backed securities. On the outside, these looked safe. Rating agencies even gave them high marks. Investors around the world bought them up. Pension funds, insurance companies, even foreign governments. Everyone thought they were buying gold. But really, they were holding dynamite. So here's the hook. What happens when almost every major financial player is tied to the same bad bet? You don't just get a problem. You get a crisis waiting to explode. By 2006, housing prices stopped climbing. Then, they started to fall. People who bought homes at high prices suddenly owed more than their homes were worth. That's called being underwater. And that's when the dominoes started falling. Those fancy financial products tied to mortgage, they started losing value fast. Banks that had billions invested suddenly faced billions in losses. Investors panicked. Here's a question for you. What happens when trust disappears in the financial system? Money stops moving. And in 2008, that's exactly what happened. Big financial firms collapsed. Bear Stearns had to be rescued. Lehman Brothers, one of the oldest investment banks, went bankrupt. AIG, the giant insurance company, needed a massive government bailout. Stock markets plunged. Businesses couldn't get loans. Workers lost jobs. Families lost homes. And it wasn't just America. Because the U.S. housing market was tied to global finance, the shock spread everywhere. Europe, Asia, South America, no one was untouched. Let me ask you this. If the economy is like a body, what happens when the heart stops pumping blood? Everything shuts down. That's what 2008 felt like. Governments scrambled to act. In the U.S., the Treasury rolled out a $700 billion bailout plan. The Federal Reserve slashed interest rates to near zero. Money was pumped into the economy to keep banks alive. Did it work? Yes and no. The financial system was saved from total collapse, but regular people didn't feel saved. Imagine watching banks that caused the crisis get bailed out while you lose your job, your house, or your savings. How would that feel? Anger boiled over. People blamed Wall Street greed, government failure, and a system that rewarded risk-taking but punished everyday workers. The effects were massive. Unemployment hit nearly 10% in the U.S. and millions of homes were foreclosed. Retirement savings shrank. People delayed college, canceled plans, and faced years of financial stress. And the ripple effects didn't stop. Europe plunged into its own debt crisis. Trust in banks and governments crumbled. So what ended the crisis? Time, government action, and painful recovery. Banks were stabilized. Regulations were tightened to try to prevent another meltdown. Slowly, the economy crawled back. But for many, the scars never fully healed. The 2008 housing crisis wasn't just about numbers. It was about choices, greed, denial, and risky bets. And it proves something important. When a system is built on shaky ground, one crack can bring it all crashing down. So the next time you hear about a housing boom, or stocks soaring, or easy money, ask yourself, is this real growth or just another bubble waiting to pop? Because history has shown us bubbles always burst. And when they do, the shock waves can shake the whole world. Don't forget to like and subscribe. Thanks for watching.